Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at Options Play. And today we're here to talk about option strategies to trade in neutral and choppy markets, which is largely where I think we find ourselves in over the past few months as the bull market has certainly at least come to an end. The question for many investors as to whether we're entering a bear market, but in between that transition, we're in this, what we would typically call choppy trading, where the markets spends a couple of weeks moving higher and then spends a couple of weeks moving lower. And we trade in this range bound motion, and there isn't a broad trend to the broader markets. There's a lot of chop, there's a lot of volatility. And the question is, as a long-term investor, these are not great markets to invest in because you're not necessarily expecting a lot of capital appreciation. At the same time, you're expecting a lot of volatility, which makes it markets very nervous. As things start to accelerate to the downside, we tend to see a lot of longer term investors sell out of some of those investments, hoping to prevent some further losses. And this is really sometimes a really difficult time to navigate the markets. And if you tend to agree with that, please type 1 into the chat window. If you find that these type of markets that we find ourselves in is difficult to read and understand as to how to go about trading it. And I see a lot of ones coming across the screen. So as we think about that, today we want to discuss kind of as an options investor, what type of option strategies can you utilize in this type of market condition, and what are the best practices around those types of strategies? So before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. So what we're going to do is we're going to first talk about identifying neutral markets, because it's important for us to understand when these types of strategies that we're going to discuss today are suitable. And I tend to find that for many investors, when we talk about the term neutral markets, most traders tend to identify these too late. So I want to talk a little bit about what type of data points do we typically look at to identify what is likely going to exhibit a neutral or sideways market. What do we look for? Then we'll talk a little bit about 3 different strategies to trade these. The first one we're going to talk about are credit spreads. Then we'll talk about short straddles and strangles. And then we'll talk about iron condors. These are 3 option strategies that you can deploy in these types of market conditions and potentially profit from a sideways and neutral market. Then we'll talk a little bit about the trading tips of these strategies before opening this up for Q&A here at the very end. But the primary thing that I want to help you walk away from today's session is a clear understanding as to how do you identify a neutral market and profit from it using an option strategy. So with that, my name is Tony Zhang. I'm the Chief Strategist here at Options Play, and I want to share with you my trading experience, and based on the 16 years of experience that I have with navigating the markets, how I've been able to look at the markets to identify these opportunities. How do I find option strategies that allow me to potentially profit from these types of moves? So let's start off by talking a little bit about what is a neutral and choppy market. Now, neutral and choppy markets are I think for most people very clear. It's when the markets are not moving in a specific trend, they are moving sideways, and they generally speaking tend to move between a range, a top end of the range, a bottom end of the range, and they simply just chop between these 2 ends of the extreme. I think we all understand what a neutral and choppy market is. However, what I tend to find that most investors do is that once they've established a range, they say, okay, I've seen the market. It's been trading inside of a range for a few weeks time. I think the markets are neutral now. Let me go and deploy a neutral strategy. The one thing that I want to say is that based on my observations of working with clients over the past 16 years, is that most of the time when retail investors identify a neutral market, that is usually the worst time to deploy a neutral strategy, because usually by the time you've identified a neutral market, it's late in the game already. And that's actually when the stock or the asset that you're looking at actually has a higher probability of breaking out and making a big move, the exact opposite of what you call a neutral and choppy market. So when you see that the stock has been trading in a range for a while that intuitively makes sense that those are neutral opportunities, statistically speaking, and based on the actual data, that actually ends up being sometimes the worst times to take a look at those strategies. So the question is, how do you determine when the markets are going to be neutral? And this is really where, if you look at a chart, even just looking at a chart itself, you can tend to see that these types of neutral markets tend to happen after relatively sizable moves in the underlying stock itself. So after the stock makes a big move, and they don't necessarily always have to be, but generally speaking, after the stock makes a big move, that's when they tend to move sideways. And that, from a psychology perspective also makes sense. A stock makes a big move in one direction or another. And after that big move, the market needs time to digest the changes in the underlying stock, the changing fundamentals that drove the stock significantly higher or significantly lower over a short period of time. So it's this consolidation phase, it's this digestion stage that the market needs to go through that gives us these neutral markets. So what you generally tend to find is that at the end of a big move, those are typically your best opportunities to statistically find a neutral market, rather than when the stock has already been trading in a range for a while. That's usually the worst time to deploy a neutral strategy. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. So it's important to understand, when, statistically speaking, do you tend to have neutral and sideways markets. It's not when you think the stock has been trading for a while, it's likely going to stay in that range. It's actually the exact opposite. It tends to be after a big move in the underlying stock. After that big move, that's when the markets tend to digest that information and move somewhat sideways into that neutral and sideways market. And yes, the question here from someone here is, does this same apply to indices? And the answer is yes. It applies to pretty much every asset class. There's no difference between a stock, an index, a currency, a commodity. They all exhibit very similar price behavior. So now that we've identified, when we tend to find these neutral markets, and we understand that stocks tend to trade sideways after a large outsized move, this is really where you can use different technical indicators or even sometimes statistical indicators that can help you determine whether the stock has made an outsized move or not. Whether you look at average true range or ADX, there's plenty of indicators that are available to you that give you some indication that the stock has made an outsized move. So here is AstraZeneca. AstraZeneca has made a pretty sizable uptrend over the past couple of months. AstraZeneca has been over almost 30% in the last 2 months in this particular stock. That's a big move for a stock like AstraZeneca that actually has a relatively low beta. This is a stock that generally does not move too much, but in this particular time frame, it's moved quite a bit. And once it's moved quite a bit, that's usually when you're likely to have this kind of sideways motion, if you will, to an underlying stock. If you find that the stock's been trading in a range for a while and that range has been established, that is likely too late to establish a new option strategy for a neutral market. So AstraZeneca is an example of a stock that recently has just made big moves in one direction. After those big moves, that's when we tend to see these sideways markets. So talking about some option strategies to trade this, the most common one is a credit vertical spread, a short credit vertical spread. And the reason that this is a strategy that's used for many times when you have a directional, a neutral view is because this is what we consider a forgiving directional strategy, and it has positive time decay, meaning time is going to be on your side. But the downside or the trade-off with this type of strategy is that it typically has negative risk to reward. So what you can potentially make will always be lower than what you can potentially risk on the underlying trade. So in this particular case, I was going out to May. Let's say I felt that after AstraZeneca had such a long, big move, that it's likely going to start moving sideways and it's unlikely going to move significantly higher above the current price, that's when I can sell a call credit spread. This is a bearish strategy with limited risk. In this particular case, I'm risking 2,700 crowns to potentially make 1,700 crowns on this particular trade. And the rule of thumb here is that what you want to do is go out roughly 45 days from expiration. You want to sell an at the money strike price. So when AstraZeneca is at 12.93, I'm going to sell the 13.05, which is the closest strike price to the current price of the underlying stock itself. And then I'm going to buy a 25 delta put a call or a put against that. And the reason that you want to buy that out of the money call or a put is because if you just sold the at the money call or a put, you would be taking on a substantial amount of risk, but also you need quite a bit of margin or capital to enter the trade. When you buy the out of the money call or a put against the call or a put that you've sold, you reduce the overall risk of the trade and you significantly reduce the capital requirements to enter the trade. And when you do this, the rule of thumb here is that you generally want to collect a minimum of 1/3 of the width between the two strike prices. So I'm selling the 305, 350. So that's 45 crowns. And what I'm collecting is 17.5 crowns out of 45 crowns, which is, as you can see, 38.88% of the vertical width, which is greater than 1/3. 1/3 is 33%. So what I want to collect is minimum of 33% of the distance between the two strike prices. The distance between 13.05 and 13.50 is 45 crowns. And I'm collecting 17.5 crowns of the 45 crowns, and that comes out to be 38%. So that's the general rule of thumb of selling a credit spread on a stock that you believe has exhibited some form of a neutral view or a neutral pattern. And what you want to do is, for example, in AstraZeneca, and we'll use options play to show you this strategy, when the stock is trading near the upper bound of the range, so when the stock is near the top end of the range, that's when you want to sell a call credit spread. So for example, this is the one that I was showing you here before, going out to May, selling the 13.05, 13.50 call spread here. But if, let's say, AstraZeneca now moves down to, let's say, 11.55, then what you want to do is sell a put credit spread. So what you're playing is the range. You're basically saying that when it's near the bottom of the range, I think that it will trade lower. And when it's near when it's near the top of the range, you sell a call credit spread because you believe it's going to move lower. And then when it's trading near the bottom of the range, you would sell a put credit spread because you believe it's going to bounce higher. So you can play both sides of the coin and you can actually make multiple trades within that trading range. So for example, when you have a stock that's in between the range, you might sell a call credit spread when it's near the top end of the range. And then when it's near the bottom of the range, you sell a put credit spread. And then you might actually sell multiple call credit spreads before you actually end up closing out the trade, because a stock can stay in the range for a while. You many times could sell 2 call credit spreads, 2 put credit spreads before it starts to break out from the range, and then you're collecting a fair amount of premium in between that time frame. So the goal here is to just wait for the stock making a big sizable move that determines that the stock will likely trade in a range. When it's near on the top of the range, you sell that call credit spread, and then when it's near the bottom of the range, you sell that put credit spread, and you're basically playing the bounce between the top end of the range and the bottom end of the range. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay. So when we talk about credit spreads, generally speaking, there are we'll talk a little bit now that we've talked about how to enter the credit spread, let's talk a little bit about what are the ways to manage these, because there's a little bit of work to do with managing these trades, and there are 3 possible triggers to exit the trade. You can either exit the trade at a profit, at a loss, or if the trade enters 21 days to expiration and it has not triggered a profit or a stop loss order, it's still time to get out of the trade. Because time is on your side, but you're short the option, to avoid early assignment and to avoid assignment overall on the trade, there needs to be a time component to the trade. So in this particular example, let's say I sell a credit spread where the distance between the 2 strike prices is 15 crowns apart. And we know that we want to collect a minimum of 1/3 of the 15 crowns. So let's say out of the 15 crowns, I'm collecting 5 crowns, 1/3 of the vertical width. What you want to do is you want to determine when you want to take profits and when do you want to cut losses. And because this is a short strategy, when you sell something for 5 crowns, you want it to go lower. And the rule of thumb here is that if it moves lower down to half of the max gain, so that when you sell something for 5 crowns, the most you can potentially make is those 5 crowns. So when you make half of that amount, 2.5 crowns, that's when it's time to start taking profits on the trade, especially if you only trade 1 contract, you want to start taking profits. If you're trading multiple contracts, you should generally close at least half the position once you reach half the max profit. And then you can always have the remaining half to try to hold that trade to expiration to try to collect the full 100% of the max gain. Now, on the flip side, if let's say you sold something for 5 crowns and it starts to move in the opposite direction, meaning the value of the option starts to increase in value. So if it starts to move from 5 crowns to 10 crowns, now you've lost 100% of what your max gain was. So if you sold something for 5 crowns and it's now trading at 10, that's usually a pretty good indication that the trading range that you were expecting the stock to trade in, the stock is no longer trading in that range. It's time to cut your losses and move on to the next trade. So when you lost 100% of the max gain, time to cut losses on the particular trade. And lastly, if the trade does not reach the stop loss level or the take profit level, but the trade has reached 21 days to expiration, it's time to cut out of the trade. You can sell a new credit spread at that time. You could basically buy back the credit spread 21 days from expiration. And you can always sell a new one if you believe that the stock is still in that range and will continue to trade in that range. But at that point, you should close out the trade, because that helps you avoid early assignment on the trade itself. So those are the rules, generally speaking, with around managing credit spreads. Does that make sense? Please type 4 into the chat window if that makes sense to you. There was a question about stop loss, so I hope that I was able to answer your question here about stop losses. So the next strategy that I want to talk about is a strategy that many investors stay away from because of the risk nature of this particular strategy, and that's a short straddle and a short strangle. And it's not for everyone, but I think it's important for us to understand the strategy and understand how it works, so that for those of you that are willing to take on the risk, you truly understand what risk you're taking and understand how large of a reward you can potentially receive from this relatively risky strategy. So we'll talk about, a short straddle or a short strangle, but generally speaking, this is a very high probability of profit trade. You have, unfortunately, unlimited risk, and it's generally speaking very suitable for when the stock has a very high implied volatility and you have a neutral outlook on the underlying stock itself. The rule of thumb here for short straddles and strangles is to also go out about 45 days. If you're selling a straddle, you're just selling the at the money call or a put. If you're selling a strangle, we generally use about a 35 delta on the strangle itself. And the only rule here is to generally avoid doing this going into an earnings announcement. And we'll talk a little bit about how to manage these trades, but let's pull this up AstraZeneca here right now on options play. And let's look at a short straddle and a short strangle. We'll look at a short straddle and then we'll look at a short strangle. And I just want to make sure that I have the strike prices that I was looking at here before 1260, 1320. So I was looking at the 1260 because that's roughly the 35 delta. As you can see here on my screen, the 1260 is a 36 delta. That's as close to 35 as I'll get. And then the 1320, which is a 41 delta, that's also the closest that I'm going to get to 35. I could do the 1350s as well, either one 1350 or 1320. Those are generally as close as I will get to the 35 deltas on these particular trades. So as you can see here, if I sold the 1305 straddle, and let me see if that's the closest. The 1290 is actually the straddle. That's going to collect me 8,331 crowns. So by May 20th, 2022, if the stock stays between 1206 and 1373, the stock's at 1290 right now. 1206 is, let me just show you this on the stock, on this price chart. 1206 is down here and 1373 is up here. So as long as the stock stays between those two numbers or those two price levels, which is a pretty wide price level, but as long as the stock stays below those two price levels, I can collect up to 8,300 crowns. That's how much the straddle will collect. The strangle will collect a little bit less, but as you can see, I have a slightly wider range. 1203 is the range, 1203 and 1377, which is up here, 1377. As long as the stock stays within that range, I'm going to collect in this particular case 5,700 crowns. So as you can see here, the two strategies have very similar risk profiles. And just to give you an idea, a lot of investors tend to shy away from these types of strategies because, as you can see, the max risk on this is technically unlimited. But I just want to show you how far the stock really needs to move before you see some significant losses. Because if you sold the straddle, you're going to collect 8,300 crowns per contract. And let's just see how far does the stock need to move before you lose 8,300 crowns. So you can make 8,300 crowns, but how far does the stock need to move before you lose 8,300 crowns? And if you use the P&L simulator, you can roughly see here, if the stock moved to 1,455 crowns, I would lose roughly 8,200 crowns. So I would lose roughly the amount that I can potentially make. That's just 1455. And just to put that into perspective, 1455 is up here. So the stock would have to exceed 1455 by the May expiration before I would potentially lose the 8,300 crowns. And let's see to the downside, how much does the stock need to move? Roughly 1,122, which is down here, 1,122. 1,122. So all the way down here, the stock would have to move beyond those prices before I would lose the amount that I can potentially make on these types of strategies. So hopefully this just illustrates to you, while this is not a strategy for everyone, this is not a strategy suitable for every day, but there are cases where, one, you're going to collect a significant amount of premium selling these types of strategies like a straddle and a strangle. And even though technically they have unlimited risk in nature, the stock would have to move a very, very sizable amount against the directional view that you have before you see some of those significant losses. And I hope that this illustrates to you just how far the stock needs to move before you actually see those losses. Does that make sense? Please type 5 into the chat window if that makes sense to you. Perfect. So lastly, what we'll talk about here is an iron condor. And an iron condor is really just taking a strangle and making it so that it has limited risk. What you're going to see is that by making a limited risk strategy, you're going to somewhat significantly reduce the potential income. But for many investors, the significant reduction in income is worth it if they can reduce the odds of loss. So let's take a look at H&M. H&M recently has made some pretty sizable moves here to the downside. Notice how after this big move to the downside, the stock moved sideways here. And recently it made another big move here to the downside. And perhaps this is another opportunity to seek some sideways exposure here. So let's take a look at a short strangle. I'm going to go out to May. We'll make this a little bit wider here. Let's look at let's do this. Let's look at the 125, 140, or let's do 125, 135 strangle, which is going to collect 790 crowns. And then let's look at a iron condor, just to show you what an iron condor really is doing here. 125, 135. And then let's do the 120, 140. Okay. So as you can see here, if I just sold the strangle, I'm going to collect 790 crowns in potential income, but my risk is unlimited in this particular case. What we're doing in an iron condor is the same trade, but instead of just selling the 120, 135, 125 put and 135 call, we do the same thing, but what we do is we buy a lower put against it and we buy a higher call against it. So what this really is two credit spreads. So we talked about the credit spreads. That was the first strategy we looked at. And iron condor is really just two credit spreads, a put credit spread and a call credit spread combined into one strategy. So as we showed you before, a put credit spread is when you use it towards the bottom end of the range. A call credit spread is when you use it towards the upper bound of the range. And you could put an iron condor that basically puts a bound on the stock itself. In this particular case, that bound is 121, 138. So basically, I'm saying that it's not going to go above 138, which is around right here. Let me move this chart to make this a little bit more clear. 138, which is around right here, and 121, which is around right here. And as long as the stock stays within this range, this iron condor will be profitable. But if the stock breaks out of the range, either to the downside or to the upside, if I sold a strangle, I would have unlimited risk. But in an iron condor, my risk is limited to only 180 crowns, while my max reward is 320 crowns. So I can potentially make more than what I'm risking. So I've established a range. The range is slightly narrower. I'm not collecting as much premium, but if I'm wrong, I can control the amount of risk that I have on this particular trade. So an iron condor, while reducing your income, also reduces your risk significantly on the trade. So that's really the idea behind an iron condor. And these all build on top of each other. Understanding a credit spread is important to help you understand iron condors. Understanding strangles, which is really just the inside strikes of an iron condor, also helps you better understand an iron condor. This really is all building on top of each other if you want to have a better understanding of these individual strategies. And lastly, let's just talk a little bit about managing these types of strategies. So in both of these types of opportunities, in strangles and iron condors, you can adjust them if the trade starts to move in the opposite direction. Basically, what you're doing here is that if, let's say, you sell this iron condor and the stock starts to drift lower, what you can do is you can take the two strike prices on the call side and move them lower here as well. And what's interesting about when you move the strike prices on iron condor lower is that by doing so, you're going to collect more premium, but you don't have to put up any additional capital to do so. So you're basically just collecting more income without taking on any additional risk. And vice versa, if you put on this iron condor and the stock starts to drift higher, what you can do is you can adjust the two put legs into a higher strike price. And again, that has the same effect of collecting more income without taking on any additional risk. So you're basically increasing your income, decreasing your risk on the overall trade, because your risk does not change on the overall trade. And you can do so whether you're doing this in a strangle or an iron condor. So if you sold the strangle and the stock starts to drift higher, you can move the put side higher and collect more premium, or vice versa. If the stock starts to drift lower, you can move the call strikes lower. So it's what we call moving the untested side. So whichever side that is moving away from the strike prices, you can move those strike prices closer to the current price. It'll collect more premium without adding on any more additional risk. And then when you're trading straddles, this is really where you need to set a max pain percentage, meaning determine at what point are you going to say, I'm going to cut my losses and get out of the trade. The rule of thumb, generally speaking, for a lot of traders is 100% of the max gain. So if you lose more than 100% of what you can potentially make on the trade, that's usually a good indication that your expected range on the stock is not holding, and it's time to cut your losses and get out and move on to the next trade. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. Perfect. Okay, that covers what I wanted to share with you here today. I hope that this was helpful in giving you an overview of the different strategies that you can deploy if you have a neutral or choppy view of the broader markets. This is going to be applied to stocks. This can be applied to indices. And what are the best practices around each of those strategies and how to manage each one of those. And more importantly, I hope that I gave you some insights into what you should look for to find stocks that are likely to trade sideways. It's not looking at the chart and waiting for the stock to start trading in range and then establishing these types of positions. It's actually the exact opposite. After the stock makes a big move, once you start to see that big move slow down, those are sometimes your best opportunities to seek some of these neutral strategies, because after a big move, something has fundamentally shifted about that stock, and the market needs time to digest information and determine what is the new normal, if you will. And that digestion and that consolidation is usually what leads to these sideways neutral markets. And those are your best opportunities to deploy some of the strategies that you learn during today's session. And if you want to learn more about options as a whole, I have a whole course on beginner, intermediate, and advanced courses that you can access at trade.optionsplay.com/NordicEDU. It really allows you to take the steps of building on the foundations, looking at some of the strategies before you can start trading and understanding some of the more advanced strategies like the ones that we explored during today's session. That really is in the intermediate and advanced section, but in order to understand those strategies, you have to have the basic foundations down. So that's why we created these courses, to help you better understand how to go through this. So this is all available for free for anyone in the Nordics. You can sign up or you access these through the trade.optionsplay.com/NordicEDU website, which I just posted a link into the chat window. And for those of you that want to access Options Play, that's the tool that I just showed you that you can use to analyze all of these strategies and construct any of these strategies. That's available to you for free at optionsplay.se with the partnership that we have with NASDAQ. So with that, I want to thank you for your time here today. I hope that this was helpful in giving you a better understanding of these strategies. And at this point, what I'll do is I'll open this up for Q&A. If you have any questions, please type your questions into the chat window and I'll try to answer as many questions as I have time for here today. Should both legs of iron condor be deployed immediately or depending upon the movement for the max gains? Great question. In my opinion, I do not I'm not a fan of trading the iron condor where you trade all four legs at the same time. I prefer to trade them as two separate credit spreads, meaning because a stock can either be at the bottom of the range or the top end of the range. They can't be at both, right? So my preference is that once I believe the stock is near the bottom of the range, that's when I'll sell the put credit spread. And then perhaps a couple of days later, the stock is near the upper bound of the range, and then I'll sell the call credit spread at that point. And when you're able to get tactical like that, you're going to be able to maximize the income you receive on the iron condor. Versus if you sell them kind of in the middle, you're never going to tactically be able to get as much income as possible and maximize your gains. So great question. My preference is to break them up into two separate credit spreads rather than trading them as a single iron condor. Any other questions? How the adjustment affect the width of the iron condor? What if market moves in the opposite direction? So great question. Um, Basically, any adjustments you're making to an iron condor makes the width narrower. You're basically narrowing the width to as far as turning it into an iron butterfly. So if the market moves in the opposite direction, you're always going to move the untested side. So if the market moves lower, you're going to move the call side. If the market moves higher, you move the put side. And you basically keep moving them until they're basically, there's no width at all. So that's how you make adjustments to an iron condor. Any other questions? Are there any stockbrokers providing low brokerage on options apart from Avanza? I would say that the best one, and when you say low brokerage, I'm guessing you mean low commissions, is going to be Interactive Brokers. Definitely by far the lowest cost brokerage firm in the Nordics that provide multi-leg execution for the types of strategies that we are discussing here today. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this evening. I hope that this was helpful in giving you a better understanding of these strategies, how to go about deploying them, and using the tools like Options Play to help you better understand and manage these types of trades. With that, thank you so much. We'll send both the recording and the slides out to you as soon as we finish processing them here today. And I will see you guys here on the next session in a couple of weeks. Thank you so much and have a great trading day.